And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Gold has been trying to decisively move over $2,000 for several years. This is the third attempt to get there and stay there. So what's it going to take? And by the way, is Bitcoin proving to be serious competition for gold dollars? We'll talk about it. Gold and gold ETFs. The doyen of gold experts is with us, George Milling-Stanley, Chief Gold Strategist at State Street Global Advisors, which runs the Spider Gold shares, by the way. That's GLD. That's the largest gold ETF, $58 billion in assets under management. Also joining us, Todd Sohn, ETF and technical strategist at Strategas, joining me here at the NYSE. George, I'll start with you. Gold bugs have been very frustrated by the inability of gold to decisively break above 2,000 in the last 3 years. I think this is the third attempt. Gold ETFs, well, we've even seen some modest outflows in the last couple of months. So what's holding gold back right now?
I think there's a couple of things. I think, it's always a little difficult in any market to get through to a new big figure and to make the change from something starting with a 1,000 to something starting with a 2,000. We've been there a couple of times over the past decade without the ability to stick. I believe that the next time we make it, which will probably be later this year or early next year, I believe the next time we make it, we may well be able to stay over there and probably even see prices at a new all-time high above the 2,070 or thereabouts that we reached a couple of years back. I think the possibility of recession is still very much in people's minds, even if some of the experts are starting to say that maybe we might actually achieve Jerome Powell's soft or softish landing. It's still very much in people's minds. I think if we did get a recession and the consequent weakness in equities, that would be very helpful for gold. And even if we don't get a recession, I think it's pretty clear that we're liable to be in a period of slower growth. And historically, gold has always done well during periods of slower growth. So I think that, I think the signs are pretty good. The only problem is a lot of people expect a lull in the gold price during the summer months. And I think this was historically the case. 20 years ago, when gold jewelry was 80% of total demand, then gold jewelry demand went very quiet during the summer, and so you expected a lull in prices. Jewelry these days, since the advent of gold ETFs revolutionizing gold investment, gold jewelry is only about half of total demand. Yeah. So I don't think we should be expecting that lull. But there are still people, speculative interests in particular, the hedge funds perhaps, who sell in anticipation of a lull in the prices during the Northern Hemisphere summer. I think that's probably the main thing that's holding us back right now.
Yeah, George, I have known you since the gold ETF was floated 18 years ago. I believe you were with the World Gold Council back then, and I've never known you not to be thinking gold is near a new high. So one thing about you is you are absolutely consistent every which way. Todd, let me bring you in here. Some call crypto, Bitcoin, digital gold. This is the crypto community, not me. Yeah. But is it? I mean, I'm curious about this problem. Has Bitcoin eaten into gold ownership?
I tend to wonder if it's a demographic issue. Baby boomers perhaps don't see that, right? They like their gold. They're perhaps a little scared of crypto. But Gen Z, some of the younger folks in our industry, I do think they consider it the digital gold of their generation. They like crypto. They like the way it is changing the world. Perhaps in a way gold, in a way, has changed the ETF industry 18 years ago. But I think the one knock against the digital gold argument is you just don't have enough history on Bitcoin and how it'll act in different environments, as we know how gold can do over the last 50 years.
Yeah, one thing is for sure, the investors believe gold has a monetary value. George, you have a new survey out. I wonder if we could put the full screen up here. You ask investors, does gold have a monetary value? 80% believe that it does. And of course, gold has a long history of use as money, but only 41% said they understand what influences the price. This intrigues me, George, because frankly, I've been studying gold for 25 years, and I'm a little mystified what impacts the price here. So I just want to show you this other survey here. Go ahead, give us a comment about what you think is impacting gold here. Is gold a hedge against inflation, for example?
Yeah, look, gold is a hedge against inflation. Gold's a hedge against potential weakness in the equity market. Gold's a hedge against potential weakness in the dollar. There's a whole bunch of different things. To me, historically, the promise of gold for investors has always had a dual nature. One, that over time, not every year, but over time, gold can help to enhance the returns of a properly balanced portfolio. and gold can also help to reduce the volatility of a properly balanced portfolio. So if gold can help to enhance my risk-adjusted returns, I definitely want a small allocation to gold in my portfolio. On the digital thing, maybe the generational thing is kind of important. There was a lot of talk a few years ago that that people were selling gold and buying cryptocurrencies. We weren't able to see any correlation whatsoever between the price of Bitcoin, which at the time was the only cryptocurrency around, and creation redemption activity in GLD, for example. We saw no correlation whatsoever there. And I didn't know of anybody who was doing that or of any advisor who was advising his clients to do that. I think the real problem in terms of looking at cryptocurrencies as a strategic asset is that effectively the crypto universe lost 2/3 of a market cap of $3 trillion last year, going from 3 trillion down to 1 trillion. That to me does not suggest, that volatility does not back up any claims for cryptos to be a long-term strategic asset as a competitor to gold. And talking about time frame, we've had cryptocurrencies for 14 years. We've had gold for 6,000. That, to me, is a statistically significant sample basis for analysis in gold and not in cryptos.
Yeah. And I'm following up on your study here, if we can put this up here. 20% of investors own gold currently. Of those that do own, it's 14% of their assets. That's interesting. And almost half of them own gold in the form of an ETF. So you're right, George. I mean, 20 years ago, obviously this would not be the case. Even 18 years ago, people owned physical gold, and the gold ETF has really revolutionized things. As for the benefits of gold investing, I just want to put this up here because most people have two ways of owning gold reasons. Maintaining or increasing value in a downturn, and some form of diversification or a hedge against inflation. So the question, is gold a hedge against inflation? I'm not sure it is, or the evidence suggests it is, but people at least do believe that at this point, George.
Yeah, look, let's address that inflation hedge one. Gold does not offer any serious protection against sudden short-term moves in the CPI or any other measure of inflation. But what gold does and has done historically, if you look just over the last 50 years, whenever inflation has been sustained at a high level, then gold has done very well. Let me define those terms in the interest of clarity. The sustained, I mean at least a 2-year period and preferably longer. And at a high level, I mean inflation, CPI, running at more than 5% a year consistently. We haven't had that in this current bout of inflation. We're getting fairly close in terms of the time frame. We're only a month or so out, but we're now below that 5% level. So we haven't had sustained high inflation, as I've just defined it, this time around. So that, I think, is one of the reasons why gold has not done as well as a lot of people expected it to. I think there's a lot of misunderstanding about the relationship between gold and inflation.
Yeah, I want to switch and talk about the demand side, because to me, that's the most interesting thing here. A lot of this gets very academic to me, but to me, the most single important determinant of gold prices is demand. And mostly, it comes in the form of jewelry from the buyers in China and in India. So I just want to show this full screen about where gold actually goes, annual demand. 50% of all the gold that's manufactured in the world goes to jewelry. And again, this is from the buyers mostly in China and India. And then there are investments like ETFs, for example. And then there are central banks at 15%. And then there's industrial, and those are mostly electronic uses. So, George, I'm wondering if you could explain this jewelry component here. So China and India are the two biggest consumers of gold jewelry. There was a decline in gold purchases during COVID, right? That definitely affected the price, I would think.
Yeah, no question. I mean, gold typically before COVID, gold was running anywhere from a half to 2/3 of annual demand. That dropped to less than 1/3 during 2020 with the advent of COVID. We didn't see much in the way of a recovery in 2021. Many of us were optimistic we might see a rebound in gold jewelry demand in 2022, but the world's biggest consumer, China, as you say, kept to its zero COVID policy until December of last year. So no significant rebound in gold jewelry demand. The zero COVID policy has gone away. we are still optimistic that as and when the Chinese economy starts to really motor, it's not doing that at the moment for a whole variety of structural reasons, but as and when the Chinese economy really starts to motor, then I think we'll see that rebounding gold jewelry demand there. And as goes China, so go the rest of the emerging markets. It's not just China and India, it's Vietnam, it's Indonesia, it's Thailand and Korea. It's a whole raft of Asian countries that are really the main drivers of gold jewelry demand. And we haven't yet seen a big rebound there, but I believe that we will. That's part of the reason for my optimism about the price.
And one of the things, I did a special with you 12 or 13 years ago, George, where on gold, where one of the things that truly struck me was how important gold is as a component of household wealth in China and in India. And there were parts of rural India still where if a woman's divorced, what they own is their clothing and their jewelry. So I think people need to understand that component of gold as a piece of household wealth that it may not have necessarily in the United States, where it's largely decorative and ornamental, but it's viewed differently in other parts of the world.
Yeah, there are huge differences in jewelry demand on Fifth Avenue or Rodeo Drive in this country, and in the Javeri Bazaar in India or in Shanghai or Beijing. Very, very different. And at our peril, we make the mistake of thinking that jewelry demand is homogeneous all around the world. That is absolutely not the case. It is culturally much more important, much more vital to people's lives in the emerging markets than it ever will be again in this country or in the Western world as a whole. And I think that is one of the keys to trying to understand what drives the price. You put up that graphic earlier saying that 41% of people, only 41% of people felt they understood the drivers. The problem there is that the drivers change in nature. Sometimes investment demand is the driver, sometimes jewelry demand, sometimes even central bank buying can be very, very helpful for the price, as we've seen over the last 12, 13 years. So there's a whole raft of different things that drive prices, and it's really important to spend some time studying those or to talk to people who really understand them before making those investment decisions.
Todd, one of the things that's striking about gold ETFs is that the investors now have a lot of choices when it comes to these gold ETFs. Now, remember, they own physical gold. You're buying an ETF and it's backed by a physical gold. But the fees can really vary quite a bit here. There's fairly new products, or at least in the last few years, new products from Granite Shares, and even State Street have a competing product that offer lower fees than the two giants. So GLD is far and away the biggest one. That charges 40 basis points. iShares Gold, IAU, charges 25. But Spider, State Street, has its own gold mini shares that charge 10 basis points. It's the same product. And Granite Shares charges 17 basis points. Quite a difference there.
It's the cannibalization that goes on within the ETF industry. You see it with gold. You see it with the QQQ. You look at QQQM, it's 5 basis points cheaper, and that's taking in all the flows. So long-term gold investors need cheaper options, especially if that allocation continues to grow. And so Spider, State Street addressed that. Granite Shares addressed that. And I think this is going to continue. You're going to see more and more fee pressure for those less daily traded vehicles, but that still have access to those types of markets.
I love how, George, you got ahead of the competition by launching the Spider Gold mini shares. I think that was, 5 years ago that you did that. And you essentially got ahead of the competition, right?
Yeah, look, we were aware there was a general trend across the whole universe of ETFs, not just gold ETFs, toward lower expense ratios and lower share prices. And we wanted to offer people a product within the State Street family and the World Gold Council partnership that we have. We wanted to offer people a product of ours within that space. So we launched GLDM with the view, with luck, to being the leader in the low-cost space. We've clearly achieved that. The rest of the competition is basically virtually non-existent. What we didn't expect, and we've been very happy to see, is that GLDM very quickly established itself as the third largest gold ETF in the United States, behind only GLD, the market leader because of its liquidity, and behind IAU. And when we look at a straight up comparison between IAU and GLDM, the 15 basis point difference in the expense ratio is literally the only difference. The structure is exactly the same between the two. So GLDM makes a lot of sense there. We have the two products because a lot of investors want the benefits of the liquidity that GLD as the market leader has. That means that the spread between bid and ask on GLD is about 1/10 the size of the spread of any other gold ETF on a comparable basis. So if you want to rebalance, to maintain a strategic allocation at a fixed percentage in a portfolio, then GLD is obviously your vehicle. If you want to trade on a regular basis, on a tactical basis, then again, GLD is your vehicle. If you simply want to put a fixed amount of money into a gold ETF and put it over in the corner and forget about it, happy that your cushion is there if ever you need it, GLDM then comes into its own with that 10 basis point expense ratio. That's exactly the way that investors have been telling me that they think about them. A lot of investors out there own both products. One for a long-term strategic allocation and the other for something they want to rebalance on a regular basis. Makes an awful lot of sense.
It does. I mean, on a daily, if I'm an active trader, I'm not, who cares about 40 basis points? I'm trading in and out on a daily basis. Exactly. I don't care. I want tight spreads. I need liquidity. There it is. There's GLD. And this is true of other products that are out there and other asset classes. If I don't care, I don't want to pay 40 basis points. I want to put it away for 5 or 10 years. I get 10 basis points it costs me.
It's all time frame. And I think it's interesting, too, that the gold ETF space is also seeing buffered ETFs come into play, your option income plays. So let's just say gold stalls out for however long, you can still generate income through those other ETF products. So more accessibility for investors out there interested in that space.